Hello students, I hope you all are doing well, and at this particular situation of this global pandemic, I wish for your good health. Stay home, stay safe, but stay focused. Don't let this issue affect your studies. So stay in touch with studies. So let's start our lecture from where we left it in previous video. We have discussed the meaning of goods. Let's move to the next term, that is stock. So stock basically means what? See, it is not practically possible all the time that how much goods I have manufactured or converted into finished goods are sold by the end of accounting year. I might be having some unsold goods as well left with me. So that unsold goods are basically known as stock. So the quantity which remains unsold with the business is termed as stock. And stock is categorized as opening stock and closing stock. See, the term opening stock and closing stock are nothing but merely a difference of one day. If my one accounting year starts on 1st April 2019, ending on 31st March 2020. So my next accounting year will be commencing from 1st April 20 and will be ending on 31st March 2021. So there is a change of just one day at closure of one accounting year and the beginning of next accounting year. At the end of one accounting year, the unsold goods left with the business is termed as closing stock, and on the very next date at the commencement of new accounting year, that closing stock becomes opening stock. So the opening stock means the amount of unsold goods with the business in the beginning of accounting year, and the closing stock means the amount of unsold goods with the business at the end of accounting year. Since we have classified goods in three categories, that is raw material, work in process, and finished goods, so the stock can also be categorized as stock of raw material, stock of semi-finished goods or work in process, and stock of finished goods as well. Stock might be available in any of these three stages, that is stages of goods. So stock could be of raw material which have not been processed, stock of work in process, that is semi-finished goods, and stock of those goods which are ready to sold in the market, that is a stock of finished goods. So stock basically implies the amount of goods left unsold by the end of accounting year. Let's move to the second term, assets. See, the basic meaning of asset is anything, any property over which business have all the rights to sell it, to dispose it, to grab some benefit out of it. So assets basically means the property of business which business is free to use, and anything which is going to give any sort of benefit to the business in near future is basically asset of a business. What does the definition states? That anything which is in possession of business or anything over which business have all the rights to use it, sell it, dispose it are the assets of business. If we talk about an individual, if I am having a vehicle, I am having a cell phone, if I'm having a laptop, all these are basically my assets. In the same manner, all those things which are in possession of business, for an example, building in the name of business, a piece of land acquired in the name of business, plant and machinery, tools, equipments, cash, bank balance having with the business are all basic examples of the asset for any business. Asset is categorized in three categories. First one is non-current assets, second is current asset, and third is fictitious asset. Let us discuss these things in detail. Non-current assets are further classified in two categories, that is intangible asset and tangible asset. Now, first let's understand the meaning of non-current assets. So those assets which are put into use for business for a period of more than an year, that is for a period of more than 12 months. Any assets which a business tends to use for a period of more than an year, or any asset which is going to give benefit to the business for more than a period of 12 months are termed as non-current assets. These are further classified in form of intangible and tangible asset. So what are intangible asset? Intangible basically means those things which do not exist in real world. Their physical existence is nowhere in the world, so they can't be seen, they can't be touched. Intangible basically means those things which cannot be touched. So intangible non-current assets means these assets can't be seen or touched. They do not have any physical existence. So what are the examples of intangible assets? Examples are patents, copyrights, goodwill, etc. Patent basically means any sort of innovation or invention registered in the name of some person which is going to give certain sort of monetary benefit to that person. For an example, you must have studied some innovations or inventions registered as a patent under the name of some prominent scientists. So patent is an intangible asset. It gives you exclusive rights to use that innovation, to use that technology. For example, bulb was invented by Thomas Alva Edison. So under the name of Thomas Alva Edison, that innovation, the technology was registered. So it was exclusive right of that particular scientist only. He can grant permission to others to use that technology against which he can make certain sum of money. Copyrights basically means some creative or artistic work registered or secured under your name. So for an example, if a musician has composed a tune, if a writer, if an author has written a novel or a book, they want that book or that tone to be exclusively registered under their name only, so that no other person can use those artistic works without their permission. So what they can do, they can apply for a copyright registration over those artistic work. Third example, that is goodwill. Goodwill is basically your brand value, your good name, your image in the market. Say for an example, if I take two names here, Reliance Industries Limited, Tata Group of Industries. There's a brand image, brand value associated with these names. We have a sense of faith in these companies. We have a value, a trust associated with these companies. So what is basically this trust? This is basically goodwill, good work of the management, of the owners of that organization. That is the basically meaning of goodwill is. Let's move on to the tangible asset. So just opposite to intangible asset, tangible means those things that can be seen, touched. They do have a physical existence. So example of tangible assets are building, land, machines, tools, vehicle, equipments, and lots more. So that is basically what non-current asset is. Let's move to the current assets. Just opposite to non-current assets, which will be putting to use for a period of more than 12 months, or which will be getting converted in cash after a period of more than 12 months, current assets are those assets which are put into use within a period of 12 months, or which will get converted into cash. It liquidates itself within a period of 12 months, or the benefit arising out of those assets will be delivered to the business within a period of 12 months. So any asset which is utilized, which is converted into cash, or benefit arising out of which is received to the business within a period of 12 months is basically current asset. Example, cash in hand with the business, cash at bank with the business, and others. So non-current assets are those assets which are put into use for more than a period of 12 months. Current assets are those which are put into use and gets converted into cash within a period of 12 months. Let's move to the third type, that is fictitious assets. See, one thing you should make clear in your mind, fictitious assets are not actually our assets, but they are unwritten off expenditures. By the term unwritten off expenditure, what we mean, see, all the incomes and all the expenses of a business are shown in a single account by the end of any accounting year. That account is profit and loss account. All the incomes are posted, all the expenses are posted to the respective sides of profit and loss account. So throughout the year, whatever expense was incurred by business will be shown, will be recorded in profit and loss account by the end of accounting year. But there are some expenses which cannot be recorded completely, which cannot be written off completely in one accounting year. Rather, they are written off in installments over a particular period of time. So the written off portion is recorded in profit and loss account, and the remaining portion left, that is unwritten off part of any expenditure, is basically known as nominal asset or fictitious asset. Precisely, fictitious assets are unwritten off expenditures, will be recorded as an asset until they are completely written off from the book of accounts. So fictitious assets basically means those assets which will never be realized in cash. These are unrecorded expenditures, so obviously these cannot be converted into cash. It includes expenses which were not written off. Examples are advertisement expense or debit balance of profit and loss account, etc. So these are the basic classification of assets. Non-current assets, which will be put into use for a period of more than 12 months, or the benefit arising out of those assets will be receivable over a period of more than 12 months. Current assets, which are put into use within a period of 12 months, or the benefit arising out of those assets will be utilized within a period of 12 months. And the third one is fictitious asset, which is not practically an asset, but unwritten off expenditure, will be written off over a period of time. Let's move to the next term, liabilities. Just opposite to assets, that is the property of the business, that is anything which is in possession of business. Liabilities are just opposite things. Liabilities are those outstanding sum of money, are those dues which a business has to suppose to pay it off in near future. Liabilities are those amount, those sum of money which a business has to pay off to someone else in near future. For an example, if I have taken certain sum of money from my relative, from my friend, so after a certain period of time, I am supposed to give them back their money. If I have taken a loan from a bank or any financial institution, then I am supposed to repay that loan within stipulated period of time. So that is basic example of liability. Any sort of money, any sum of money which I am bound, which I am liable to pay off to someone else after a certain period of time or within a stipulated time is known as liability. Liability can be classified as internal liability, external liability, non-current liability, and current liability. See, internal liability basically means any sum of money, any sort of outstanding due which I'm supposed to pay someone who is an internal person of the business. By the term internal person means anyone who is interested in the business, who holds a pecuniary interest in the business. Any insider could be director, owner, or any management personnel to the business. So internal liability basically means a business has to pay to any of the insider person. For example, We have already discussed the meaning of capital. Capital is something which is invested by a businessman in order to start a business. Business treat that amount, that capital, as an internal liability. So in case of winding up of a business, in case of dissolution of a business, any business enterprise owes it to the businessman that the amount of capital should be paid back to the businessman itself. Let's move to the second categorization of liability, that is external liability. So just opposite to internal liability, which is repayable to an internal person, external liability means any sort of outstanding money which is repayable to any external person, any outsider. For example, repayment of money taken from a friend who is not related with my business at all. So there's a friend of mine, I have taken certain sum of money on credit from my friend, and that friend is not related anyhow to my business. He's not the supplier of raw material. He's not an employee of my business. He doesn't hold any management position. He's not the owner or director of my business. He does not have any particular direct relation with my business. So if I have taken certain sum of money from my friend or my relative, I have to pay it back after a certain period of time. That is an example of external liability. Now let us understand the meaning of non-current liability and current liability. It goes same as in the case of non-current assets and current assets. The basis of difference is time period, that is period of 12 months. As in the case of non-current and current assets, same goes with the case of non-current and current liabilities. So those liabilities which we are supposed to pay off after a period of 12 months are known as non-current liabilities or long-term liabilities as well. Opposite to that, those liabilities which we are supposed to pay off within a period of 12 months are known as current liability or short-term liabilities. What does it states? That non-current liability will be paid after a period of more than 12 months, for example, long-term bank loan. Whereas in context of current liability, it states that will be paid within a period of 12 months. For example, payment of goods purchased on credit. I have purchased raw material, I have purchased goods from a seller, and I have promised him to pay his money back after a period of 50 days. So that is less than 12 months. It will be treated as current liability. Precisely, basic difference between non-current and current liability is the period of 12 months. Non-current liabilities are payable after a period of 12 months, whereas current liabilities are payable within a period of 12 months. Let's move to the next term. So these are some related terms. We have taken 4 terms basically here: revenue, income, profit or loss, or gain. We will be discussing all these terms simultaneously because somehow they are relatable. Students often use them interchangeably in their regular course of life, but in context of accounting, they have distinct meaning. So let's first discuss the meaning of revenue. In the field of accounting, revenue basically means the sum of money received from sale of goods only. Revenue basically means inflow of money resulting out of sale of goods only. So any sum of money received from sale of goods or any sum of money received from any repetitive source will be termed as revenue. Now, what's the meaning of repetitive source? Any source which is going to result in inflow of money repetitively throughout the year. Say for an example, I have let out my property on rent on a monthly basis. Then my tenants would be paying me rent every month. So here, inflow of money in form of rent will become a source of revenue for me. So revenue precisely means either sale of goods or inflow of money from a repetitive source. Let's move to the second term, that is income. See, there is slightest difference between the term revenue and income. Where revenue means sale of goods, income means the difference between revenue and the expense. For example, goods were sold for rupees 1 lakh. We have already discussed inflow of money by selling goods will be termed as revenue. The amount received by selling goods will be termed as revenue. So here in our example, 1 lakh is revenue, whereas the cost of purchasing and manufacturing these goods was rupees 80,000. In order to make any good sellable, first I have to purchase raw material and manufacture it to make it sellable. So I have sold the goods for rupees 1 lakh, whereas the cost for me was rupees 80,000 for these goods. So the difference of amount which I have earned, that is rupees 20,000, will be termed as income for the business. So revenue means amount received from sale of goods, whereas income means difference between the amount received from sale of goods and the cost of those goods. Let's move to the third term, that is profit or loss. So profit basically means the difference between total revenue and total expense. See, the income is calculated at a particular point of time. If I'm doing a transaction right now, I have sold goods for rupees 1 lakh, whereas cost was 80,000. So income generated for me is rupees 20,000. But throughout the year, does a business will be performing just a single transaction only? No, they will be selling goods again and again, so multiple time income will be getting generated for the business. So the difference between total revenue and the total expense incurred throughout the year is termed as profit. Basically, profit is calculated over a period of time, whereas income is calculated at a particular point of time. That is the difference between income and profit or loss. So the difference between total revenue and total amount of expense incurred throughout the year is profit, and loss is vice versa situation. If total expenses are more than total revenue, if my expenses are more than my revenue, surely my business is in situation of loss. The last term is gain. Gain also means inflow of money. The only difference between profit and gain is the speculative nature of gain, the windfall nature of gain. See, in order to earn profit, you have to make efforts, you have to work hard, you have to work throughout the year in order to earn profit. So you are devoting your efforts, you are devoting your time, you are devoting the hard work in order to earn profit. Whereas in case of gain, it totally depends on your luck. So gain is an inflow of money arising out of windfall activity. By the term windfall activity, we means activities that might happen anytime or that might not be happening anywhere. So it is kind of speculative in nature, that it might goes in our favor or not. So the gain is sum received as a result of windfall gain. Any inflow of money arising out of speculations, gift, will of a deceased person, winning of a court case, etc. are example of gain. So gain arise as a result of windfall activities, speculative activities. That is the basis or difference between profit and gain. In order to earn profit, you have to do a lot of efforts, whereas gain totally depends on your luck. It is speculative in nature. Let's move to the next term, that is receipts and expenditures. By far, receipt means any inflow of money and expenditure means any outflow of money. Receipts result in inflow of money, whereas expenditure result in outflow of money. Receipts are further classified in two categories, that is revenue receipts and capital receipts. See, from here onwards, understand the meaning of term revenue and the term capital. First thing, this particular term revenue should not be confused with this term revenue, which we have discussed. Here, revenue means sale of goods, whereas now what we are discussing is kind of transaction. So transaction can be classified in two categories: transaction of revenue nature and transaction of capital nature. Transaction of revenue nature means those transactions which happens repetitively throughout the year, whereas transaction of capital nature means transactions which does not happens repetitively throughout the year. For example, purchase of raw material is a repetitive transaction, so it is an example of revenue nature transaction. Whereas purchase of new building, new land, new machine happens once in a while. It doesn't happens on a regular basis. It is not like I am going to purchase new building every month, every quarter, or every 6 monthly. So revenue nature transactions means transactions of repetitive nature. It repeats and repeats again and again throughout the year. Whereas transaction of capital nature means transactions of non-repetitive nature, that doesn't repeats itself again and again. It happens once in a while. So that is the basic meaning of revenue nature transaction and capital nature transaction. Why we are discussing this particular thing right here? Because it will makes easier for you to understand the meaning of revenue receipts, capital receipts, revenue expenditure, and capital expenditure. So let's move ahead. What does the term revenue receipts means? So any sum of money received from repetitive source such as sale of goods, rent received, commission received, etc., will be known as revenue receipts. So any source of money from where money can comes in on a repetitive basis is an example of revenue receipt. Basically, this particular revenue which we have already discussed, that is sale of goods, comes under the category of revenue receipts itself. Then what does the capital receipts means? Inflow of money from non-repetitive source. So any sum of money received from non-repetitive source such as sale of old asset, sale of old investment, sale of old furniture, etc. So any sort of money received from non-repetitive source will be termed as capital receipt. Let's move to the third term, that is revenue expenditure. So any sum spent on repetitive source. We are using the term revenue now. Revenue means repetitive and capital means non-repetitive transaction. So revenue expenditure means any outflow of money on repetitive transaction. So any sum of money spent on repetitive things such as payment of salary. Obviously, we have to pay salary every month to our employees. Payment of rent, if I have acquired some property on rent. Payment of wages to the laborers working in the factory, payment for purchase of raw material, etc., are all example of revenue expenditure. Whereas capital expenditure is just opposite. So the outflow of money or the expense incurred on non-repetitive source will be termed as capital expenditure. So any sum of money spent on non-repetitive things such as acquiring new asset, making investment in the market, purchasing furniture, purchasing land, purchasing machineries are example of capital expenditure. See, in capital receipts, we were selling old assets, old investments, and in capital expenditure, we are buying new assets, new investments. The third category of expenditure is deferred revenue expenditure. I would be relating deferred revenue expenditure with fictitious asset, which we have already discussed previously. Why we are discussing or relating these two particular things? Because ultimately deferred revenue expenditures are the one which are going to become fictitious asset. As we have already discussed, fictitious assets are unwritten off expenditures. Those expenditures which are not written off in one accounting period but are amortized or written off over a period of time. So deferred revenue expenditures are the reasons why fictitious assets gets created. So deferred revenue expenditure means there are some expenditures which are incurred in current year as a revenue expenditure, but the benefit will be arrived from them over a certain long period. As such, the whole of expenditure cannot be debited to profit and loss account. So deferred revenue expenditures are written off year by year in part. So the written off part which has been written off in this accounting year will be posted in profit and loss account, and the remaining portion, that is unwritten off part left out of deferred revenue expenditure, will become the fictitious asset, the nominal asset. So there is a direct relation between deferred revenue expenditure and fictitious asset. That is why we are relating these two topics right here. Fictitious assets basically gets created out of deferred revenue expenditure only. So we have discussed few further terms in this particular lecture. We are left with further terms as well. Those terms will get covered in next coming lecture. We will be closing off this lecture right here. Stay tuned for next video to come, and thanks for watching.